Why is Wall Street supporting bigger rate cuts in Q4? Well, let's dive in. Wall Street is showing a robust support for larger interest rate cuts in the fourth quarter of the year. This enthusiasm is fueled by investors who are pushing stocks to unprecedented highs. It's an optimistic scene, one that's banking on the power of rate cuts to spur economic growth. But the optimism doesn't stop there. Traders are eagerly anticipating additional cuts, going beyond what the Federal Reserve has hinted at. And what's the driving force behind this anticipation? It's the cooling inflation. Yes, a slowdown in the rise of prices is making traders hopeful for more aggressive rate cuts. Now let's turn our attention to the experts. They're of the opinion that a 50 basis point cut is not just desirable, but crucial. And why is that? It's because they believe this cut is necessary to prevent the economy from slowing down. They see it as a preventive measure, not a sign of impending doom. Thus, Wall Street's support for bigger rate cuts is based on a proactive approach to prevent an economic slowdown. Fascinating, isn't it? How could these bigger rate cuts impact the economy? Let's dive into it. The Federal Reserve's decisions in the final months of the year, namely November and December, are crucial. They will be heavily influenced by key jobs reports. These reports will provide insights into the health of the job market, which is a significant factor in the Fed's decision-making process. Now, experts believe that the Federal Reserve's proactive stance will act as a cushion, preventing a hard landing for the economy. This means that even if economic growth slows down, the impact would be softened, minimizing potential negative effects on businesses and households. But what does this mean for investment and market resilience? Well, the optimism surrounding these anticipated rate cuts could inspire a surge in investment. Investors are likely to take advantage of lower borrowing costs, driving more money into the economy. This influx of investment could, in turn, bolster market resilience, helping the economy withstand potential shocks or downturns. Therefore, these bigger rate cuts could stimulate investment and bolster market resilience. And that's a snapshot of the potential impact of these larger rate cuts on the economy. But what does this mean for mortgage rates and housing affordability? The anticipation is high for further decreases in mortgage rates following the Federal Reserve's recent rate cuts. Experts are forecasting a decline in mortgage rates in the last quarter of 2024, with a strong possibility of additional rate cuts in November and December. While the Federal Reserve doesn't directly control mortgage rates, lenders typically adjust their rates in response to the Fed's actions. This could mean potential reductions in monthly payments for many homeowners and prospective buyers. However, it's important to note that lower mortgage rates don't always translate into improved housing affordability. Rising home insurance costs, for instance, could offset these potential savings. So, even with lower mortgage rates, overall housing affordability may not see significant improvements. In conclusion, while these rate cuts may lower mortgage rates, they may not necessarily improve overall housing affordability. Thanks for watching. Stay tuned for more updates. Please like and subscribe.